Okay, let's dive into something that might sound almost too simple to be true. Our source material today looks at this really interesting question. What if skipping something small, like, your daily coffee, maybe?
Yeah, or that quick lunch you grab.
Exactly. And investing just that amount instead, what if that could actually lead to, well, significant financial growth over time?
And it feels a bit counterintuitive, right?
Yeah.
Just $5. Totally. But the source actually documents a specific experiment. Yeah. Someone really put this idea to the test. They committed to investing just $5, but like every single day,
Yeah.
consistently for a year, and then they kept watching.
Okay, so our mission here in this deep dive is to kind of pull apart how they did it, look at the results, which had a bit of a surprise, and figure out the key lessons that you, listening, can maybe take away from their whole experience.
Right. So the core idea was definitely simple, $5 a day. But the plan had some smart strategies kind of baked in.
Like what? I mean, how is just putting cash aside different from what they actually did?
Well, a really crucial part was automating the investment.
Ah,
That takes the emotion out of it, and it builds consistency without you having to actively remember every day. They also chose a diversified investment, specifically an S&P 500 index fund.
okay. And for someone just putting in $5, why is something like an S&P 500 fund important? Why not just pick a stock?
Because it spreads your risk, right, across 500 of the biggest US companies. You're not putting all your eggs in one basket. It's a way to get broad market exposure, even with like really small amounts.
Got it. And the source also mentioned using a tax-free account, like an ISA here or a Roth IRA in the States. Why is that so key?
Yeah, that's important because it means when your investment grows, and we'll see theirs, you don't lose a slice of those profits straight away to tax. It lets your gains compound without that tax hit.
Makes sense. The source also flagged the platform they used, Trading 212, and some of its features. Why was that platform relevant here?
Well, things like low fees are a big deal when you're investing small amounts daily. You don't want charges eating up that $5.
Sure.
And crucially, features like their auto invest function and fractional shares. They were pretty essential. Yeah, it
Fractional
just
share.
means you don't need to buy a whole share of, say, Apple or an ETF, which might cost hundreds. You can buy just a fraction of one. Perfect for investing that $5.
Right, okay. So the plan. $5 a day, automated diversified S&P 500, tax-free account, using a platform that allows tiny, regular buys. Got it. So what happened after the first
So
year?
the numbers the source gives are pretty clear. They invested $1,825 total. Yeah, $5 times 365. Okay. Their portfolio value after that year was $1,986.
Okay, so a profit of $161, that's an 8.8% return, which is definitely better than zero,
Absolutely.
but maybe not the kind of thing that makes you jump up and down immediately.
Exactly. It's solid. It proves the consistency pays off. But yeah, maybe feels a bit modest at first glance.
Here's where the source has that like twist you mentioned. They kept tracking for just 5 more months. On the results, they accelerated a lot.
They really did. Yeah, in just those extra 5 months, the profit jumped up to $576.
Wow.
And if you look at the total they'd invested by then, that return shot up to like 43.8%.
Whoa, hang on. From 8.8% to nearly 44% return in just 5 more months? That's a huge leap. What drove that?
Yeah, it's pretty dramatic. The source puts it down to two main things really starting to work together more powerfully. First, the power of compounding was really starting to, well, kick in more noticeably.
And remind us, what's compounding doing here specifically?
Think of it like that snowball rolling downhill, Yeah, starts small, picks up snow, gets bigger, picks up even more snow faster.
Right.
So in investing, your early gains start earning their own returns, which then earn returns. It just speeds up your growth over time, especially as the pot gets bigger.
Like your money making money.
Exactly. And the second factor they mentioned was just strong market performance during that specific 5-month period.
Ah,
Because they were consistently in the market, they automatically benefited from that upswing.
which really underlines that whole time in the market thing, doesn't it? Rather than trying to time the market. So just being invested for those few extra months during a good patch made a massive difference.
Precisely. So, okay, let's boil it down. What are the core, like, actionable takeaways you can get from this experiment based on the source?
Okay, first one seems obvious, but maybe needs reinforcing. You absolutely can start investing with tiny amounts. That $5 a day, it adds up and it works if you do it right. Definitely.
And second, consistency is just crucial. Sticking to the plan day in, day out helps you ignore all the short term market noise and bumps. no emotional
Yeah,
reactions.
and automating it like they did, that just takes the willpower out of it, doesn't it?
Totally. It builds in the discipline. Even if you're busy or just don't feel like it one day, it happens
And
anyway.
maybe the biggest lesson, thinking about that jump in performance, you got to think long term. Don't get put off if the first year feels a bit slow. Staying invested lets that compounding and just general market growth over time potentially do much heavier lifting later on.
Yeah, I think this deep dive really shows, based on the source, that becoming an investor isn't about needing some huge pile of cash to start.
Right.
It's much more about getting simple, consistent habits in place and then just letting time and compounding work their
So here's a
magic.
final thought then for you to maybe mull over based on what we've unpacked here. What small, consistent financial habit, maybe inspired by this $5 a day idea, maybe something else could you start doing today? And how might that seemingly small action actually compound and really impact your financial future? Not just next year, but maybe, 5, 10, even 20 years down the line.